All right. Thanks, Chris. That's a great introduction. I feel so lucky that I knew Chris as a kid so I could make that connection again when I was older, because I don't know if I would have. But it's been a life-changing experience, as many of you have had. And one of those steps was actually just becoming a member of this investor club. And it was later that I had a chance to donate some money to help in Ukraine, which then also included a jet ride with Chris, where I wasn't pitching this idea thinking, hey, I wanted a partnership. I was saying, hey, I need some advice. But within about 3 or 4 minutes, Chris was like, this is phenomenal. I want to make this happen. Let's partner and fund it and make this happen. And I was, yeah, let's do it. I'm all in. And I bring up that story because I know many of you here, there might be thinking about, yes, these are great opportunities. I want to invest in these opportunities. I want to get in the Audacity Venture Fund because this is going to be such a huge play, and you should do all that. But also make sure that you're networking with those around you. You're finding other opportunities. And there's other people here that I'm working with too. And it's great to be in a room with such incredible people. So take advantage of that. All right, I want to give a little backstory to Thatch. I've been working in the retail space for a really long time. And as a retailer, I used to own running stores. And then I started building software for retailers because I was like, this software sucks. I want better software. And I learned how to code, and I started companies. But I started a company that did an e-commerce marketplace, and then we released a point of sale. And we got some traction, but it never really took off. And part of it was because I was trying to do so much of it on my own. I was trying to be the operator. I was trying to run it scarcely. I was underfunded, under-resourced, and I could only get so far. And it became clear to me actually ahead of meeting Chris that I needed to think differently. I needed to get out of that mentality of I should do this on my own or with as little resources as possible, as small a team as possible. I need to think bigger, go bigger. And that's when I brought this opportunity to Chris. And I knew as I was working on my previous company, I was meeting with lots of retailers, and it was clear there was bigger and better opportunities. And that if we were to iterate on what we were doing, again, I love that term, iterating. If we were to iterate on what we were doing and not actually just try to keep doing what we could have successfully done what we were doing. We'd grown the team and thought differently about it. But a new opportunity presented itself that was so much bigger, so much better, so much more game-changing than anything that had come before it. It was worth pivoting everything to. And we made that shift to start Thatch. Thatch is poised to capture billions of dollars in lost sale. If you think about different market disruptors, Airbnb and Uber are some of the biggest that come to mind. And if you study why they were so disruptive, there's a couple of different reasons, but it's the way that they changed the customer value chain. There's opportunities that are nascent opportunities that exist in the marketplace, but and there's an old way of doing it. So think about it like a set of chains put together. And some of these chains aren't necessary anymore because of technology. They can be removed, and then two links can be pushed together even closer. And it smooths out the speed of business. It smooths out information. And there's a cascading effects of things that happen. And that's what happened with Airbnb and Uber and their collective fields. And those are their size of their markets. 74.6 billion, 85.8 billion. That's the worldwide markets for how big they are. Thatch is going after retail, and it is a $30.3 trillion market. Once I explain the ideas behind Thatch, I want you to be thinking about the applications beyond retail for even your own businesses, because you'll realize that this actually goes beyond that. And it's also why Chris talks about why it can be so big. What is Thatch? You're probably sitting there going, okay, right, great, this is cool. What is it? Thatch is a vendor-managed inventory platform, and what that means is it allows, we wanted to solve some problems, and the problem is that retail inventory is stocked too low because retailer inventory risk is too high, meaning retailers underbuy all the time. And I'll go deeper into that in just a second. The other reason is that inventory is out of stock at retailers because they're slow to restock sometimes. And I want you to think primarily of small to medium-sized retailers, because the big dogs have actually do this already, and we'll get into that in a second. So we came up with a whole new approach. So this is what Thatch is. Thatch is a vendor-managed inventory platform where retailers don't pay for inventory until it's sold. And brands are the ones in charge of keeping inventory stocked at retailers. I'm going to dive into that first problem I brought up earlier. I want you to internalize this and think about it maybe in your own business, or if anyone's ever been in retail, you might understand this. On the right is a grid of a potential product. Think like a shirt with sizes and colors, and the one represents buying one of each, having one of each represented, and the people represent people walking into the store, demand, who would buy those products. Now, if the retailer, this is the current model. The retailer has to take the risk. They have to buy the products from the brand, and they have to pay for it in 30 days, 60 days, 90 days, 120 days. They got to pay for it no matter what. So if they were to try to capture all the demand and buy 20 units because they don't know exactly what they're going to buy, well, ultimately they don't make any money if they only sell half of it, which is why they don't do this. They're like, nah, I can't take that risk. That's too big of a risk. I go out of business. In fact, I need to sell like 100% of everything I buy. And so what they do instead is they do this. They go, all right, I'm just going to buy, I'm going to buy that shirt in black and in the different sizes. And I know that'll sell. I don't want to get risky and sell everything else. But there's people walking into their store all the time who would buy something if it was there that don't, or if it was somehow available. And so in this scenario, they sell 100% of everything, and they make an okay amount of money, and the brand makes an okay amount of money, and everything goes on. Well, what does Thatch do? Thatch takes the risk, and it moves it to the brand. It says, hey, brand, you're actually the one taking the risk now. And the brand has a lot less money in the product. So if you think about a $100 item, the brand might charge $50 to that retailer for that item, but it only costs the brand $10 to make it. And what that means is that the brand could actually afford to stock all of the units at a much lower risk than the retailer could. And if they do that, and they still only sell half, well, now the retailer's making 2.5 times more money because they're only paying for what's sold, and the retailer's making almost double anyway. And I don't mean top-line revenue. I mean profit. This changes how retail is considered and thought of and done. Now, this is just one example of the effects of Thatch. There's actually a whole cascading effect of things. Like when Chris gets up here and talks about it, he brings up other really good points. Because when you remove that link in the chain and we move retailers and brands closer together and have them work in a different way, it affects everything about how they do business. It affects how brands think about how they buy, how they supply business, how they do their manufacturing, what they order, how often they reorder, and there's a whole data flow in this whole process. So how does it work? Like, all right. So what's like? Let's get into the. What is it? How does this really work? So the brand. It's 3 steps. The brand allocates inventory to a retailer. They're the ones in charge. They have a dashboard. They figure it out. They go, this is what we want to send to the retailer. The retailer receives it. There's no financing. They get it. They stock it. They put it out on the sales floor, and then and the point of sale when it's sold to the end consumer. Thatch splits that payment up. The retailer gets their cut. The brand gets their cut, and Thatch takes its cut. What that looks like from an actual, like, what's the technology? Like, what are we building? There will be a B2B marketplace where brands and retailers find each other and connect and get together. If anyone's familiar with Faire.com, it's a little bit like that, except for it's more about connecting the retailers and brands than actually transacting on the site. Number 2 is a brand dashboard. This is where a brand actually has visibility into all the retailers that are selling their products and the ability to control that. They can see what's selling where, they get to decide what's getting restocked where, and they're using that data to feed their whole system to do it even better. And a little aside, as we get further into this, we are going to add AI to make that even easier for them to do, so that they can predictively know what to place where exactly when they should. It is a point-of-sale system, and I brought up before that my previous company had a point-of-sale system. I bought my previous company's software to build Thatch, and we get to build on that point-of-sale system, which was a really well-built point-of-sale. We also had a B2C marketplace, and we're going to make that into a B2B marketplace. The 4th piece is a split-pay technology. This is actually something we already built and allows us to do that part of the process. I brought this up earlier, but big retailers do this already. So Amazon, Walmart really pioneered this. Now, they knew a long time ago what they wanted. This made sense. They had a lot of really smart people working for them. And they built this kind of software, and a lot of other big players in this space did too. This is one of their biggest competitive advantages, is doing vendor-managed inventory. And they have a version of what I call split pay or pay on scan. It's not quite as sophisticated as what Thatch has, but it's pretty good. And so they've been in this for a while. And so in a lot of ways, we're taking this technology that actually exists, and we're bringing it to the masses. So some of the biggest benefits for this is that, I brought this up, capturing billions in lost sales. So there's actually a ton of lost demand of people walking into a retail store. And again, this works for e-commerce, but I talk a lot in brick and mortar because that's our primary and first use case, but it matters for e-commerce too. Capture billions of dollars in lost sales just because of understocking issues, basically. And that was because the retailer was taking the risk and they didn't buy enough. And now they're not. And so they will. The other benefit, it lowers the barrier to entry for a retailer to open up a retail business. And I wanted to kind of sit on that for a second, by as much as 95%. And what that really means is if I'm going to open up a small retail store, I need to buy inventory for it. It might be hundreds of thousands of dollars worth of inventory just to get it up and running. And you can sort of finance that inventory, but you only have so many days until you got to pay it, or you got to go to a bank who needs to give you enough credit to do it. And so unless you already have the credit, it just becomes really difficult. So you're still taking all that risk. Well, now you don't take any of the inventory risk. You just need to find a retail location. You need to rent or buy a retail location, do a build out, or perhaps it's already built out, and then decide what you want to carry, work with the brands, get the product in the store, and start selling it, knowing that your margins on what you sell are guaranteed. You don't have to worry about what isn't selling. The way Thatch makes money is we take 10% of the cost to the retailer. So it's coming from the brand side. It doesn't cost the retailer anything to really use Thatch. It all comes from the brand side. We may charge something for our point of sale. We're still discussing whether or not there's a fee for using just the point of sale. But the main money is coming from the brand side. So why would the brand pay us 10% on average? And it'll vary. It could be as low as 3%, as high as 20%. But 10% on average, it's because we get them more sales. They pay salespeople that kind of money. They pay distributors that kind of money to get them into more stores. It's built into their model already to pay to get more sales. This gets them more sales. In fact, I think it'll at least double most brand sales pretty quickly. This is some of our competitors and how Thatch compares. Faire, I brought that up earlier. Faire.com and Tundra are B2B marketplaces for buying products. They do not do vendor-managed inventory or split pay. They don't have the data analytics. They basically say, hey, brand, you can list your stuff on our marketplace, but we're kind of in charge of who we decide who gets to buy it. We set the terms, and they do normal 60-day terms in order to pay for it. And then the bank. The bank is actually what a lot of retailers just got to go to a bank and get financing to pay for their inventory because they just can't afford to pay that brand back right away, and they got to figure out how to make it all work. The way that we are initially have been acquiring clients is by going to trade shows. These are some of the trade shows that we've either gone to or are looking to go to. We've been to CABDA, we've been to Surf Expo, and at these trade shows, I'm going to tell you my experience. I have been to many trade shows selling different things, and when I first brought this to a trade show, we did it super last minute, and I just threw together this little pull-up banner, and we just had a table, and it was the crappiest booth ever put together. And the trade show was at there was 2 buildings, and we were in the building that had the least amount of traffic in the very back corner. And yet this sign that just said, I'm trying to remember the exact sign, but it was stop paying for inventory until it sells. I think it was either that or something like that. We were just busy all day because every retailer was wait, what? Don't pay for inventory till it's sold. They're no. What? Tell me more about that. And we were just signing people up all day long. And the only people that wouldn't sign up were the ones who just literally couldn't believe we could pull that off. Or thought there was some sort of financing thing. Oh no, it's we've got to They assume that there was some sort of debt involved. We're like, nope, it's actually the brand. The brand's taking that risk now. And then we went around to all the brands and we said the same thing. We said, hey, brand, we got this new thing. We're selling, we have all these retailers excited about it, and we could get you into more stores because they no longer are concerned, like how, they got to buy your product. Like, they don't have to buy it anymore. You just put it in their store. I mean, you got to get them to agree to carry it, but we can get you into a lot more stores that way, don't you think? They're like, yeah, actually, I do think. And so pretty quickly, we're able to build up, I would say the majority of any trade show we go to, the majority of brands and retailers we talk to sign up on the spot on a short conversation. I've never sold anything easier in my life because it's just that fundamentally game-changing. Here are some of the brands that have signed up. There are at least 100 brands who have signed up or have shown heavy interest, like, yes, I want to know more as soon as you have more to show me. Collectively, they do $500 million in estimated annual sales, which would mean $50 million in annual revenue to Thatch. This is just from us going to a couple of trade shows, getting some interest. These are our financial projections over the next 5 years. In 3 years, we expect to be doing $250 million in revenue. With the brand, the average brand should bring $500,000 to Thatch a year. Just one sale. One brand signing up. And then our net margin could be as high as 80%. Now, we may go lower than that just because we want to just fuel our growth, and that's what it would go into, is growth. And we believe that just within 3 years, we'll easily get to a $3 billion valuation. It'll probably be a lot higher. And when Chris talks about a $100 billion valuation or more, we're talking in 5 to 7 years. That's one of the fastest growing companies ever. This is a timeline of where we're at and what we're doing. We're in January 2023. We've been doing some awesome hiring. I'm going to bring that up in just a minute. And then we're going to start continuing on the development work that I had started with my previous company. We're 80 to 90% of the way there. We're so close to something that really requires a lot of software, and we really just need to cross the finish line. And in March, we expect to launch our beta. And from March to June, we'll be iterating on that beta with a set of beta customers to make it better and better. But between now and June, we're going to be selling it. We're going to be signing up retailers and brands as much as we can get. We're going to get them excited and get them on board, and in order so that when we launch, we have a huge launch, and it's just the growth should hockey stick because of the network effect between retailers and brands. And from there, we have other goals, launching predictive AI and other things that we want to do with the platform. You know me and Chris, and that's it's great. It's amazing working with Chris and his team. The partnership that we have has been truly amazing. I work with Carson a lot. He's Chris's chairman of the board, who I report with, and he's been amazing in helping me think things through and attract incredible talent. Here today with me are our first two hires, Reggie Collins and Chris Gunnels. If you're in the, I can't really see, but if you're in the back there, stand up and wave. I think Chris might be over there, and Reggie's over there. If you get a chance, say hi to him. Reggie just came over from 4UP in an operations role, and they crushed it over there, built a really awesome software in the golf course space. And I think he's going to be a rock star working on Thatch. Chris is an incredible engineer. It says VP of Business Development. That's wrong. I guess when I put this deck together, I missed something there. VP of Engineering. He's an incredible software engineer. He's helped other companies scale up to unicorn status or billion-dollar status. He has the ability to take what we've started and just run with it and help us move fast. And literally the term I use the most is iterate. Like, we have to iterate on our product to nail it so that our customers love it. Because as soon as they love it and they're sharing it with everybody else, that's the magic inflection point where it really takes off. So speed of iteration allows you to get to a place where your customers, or in our case, these retailers and brands are in love with the product. They love how it's working. It's smooth. It's giving them the data they want and the performance they want out of it. Yeah, this was part of the sales pitch. We raised $2 million as part of the equity, or not the Audacity Venture Fund. And half of it's going to building technology, a bunch of it to sales and marketing, and then some to operations. That's how we're allocating the money. That is the end of my presentation.
Guys, give it up for Dan. So go back. I want to make sure they see this on the slide before, Dan. So we're doing a $2 million pre-seed round, and we're not sure if Thatch is going to need all that. Honestly, probably not, but that's what we've set aside that we could support. And here's the exciting thing with this one. We have a short runway to actually getting this out the door, and we're so confident that we have Reggie that is already starting to form relationships. We'll be moving forward starting in February and on with basically finding brands and really trying to figure out who do you want to set this up with. If you're familiar with merchant processing, it's usually a selection process. You have to jump through hoops, and there's a setup process. And so we could pick a company that's doing $2 million a year in sales, or we could pick a company that's doing $20 million a year in sales. So we're going to make sure that the first ones that we really sign and get up going with can really start bringing some meaning volume to the table. So I think you did a great job presenting Thatch. We are going to spend a little time on this, and I want to open up some room for you to ask some questions. I just think it's awesome that this comes out of Dan actually sitting in this chair as a member of the Investors Club. So one more time, guys, give it up for Dan. That was awesome, brother. That was awesome.
Can I ask a question? I had somewhere I wanted to go with this after I finished my presentation. How many of you actually have any involvement in retail, like some sort of retail or brand, one or the other? I'm just kind of curious in this own business. There's a few, hands, right? Yeah. Okay, so and then how many of you have a business that involves inventory in some way, shape, or form? Okay, a lot. How many of you that have had that experience see the benefit, like in an inventory business, what it was do, whether it was retail or not? For those of you, yeah. Okay, then I'm gonna one more question. I brought up the ability to open up a retail store. It's so hard to see. I'm trying to in order to actually even see a hand, you have to do that.
Just pretend they're there. You're doing great.
I wanted to see the feedback.
This is so I don't get nervous when I'm up here.
It's great, actually. It is totally blank. There's a lot of opportunities, and I love what Chris trains is, with the have it all mentality is incredible and all the different strategies. And one of them is opening and starting a business, which is why franchises are such a cool thing. As this continues to evolve and move forward, and maybe even right out of the gate, one of the best opportunities is for people to open up retail stores with very little money into it and a really high ROI. And I don't know if you guys anyone's looking for a second business to open or just their first business on the side.
This group, Dan, wouldn't be open-minded to things like that.
None of you would think about that, would you, right?
Can I frame it up a little different?
Yeah,
Dan's
go
asking?
Ahead.
Imagine what Amazon did when it created a marketplace and it started running some calculations and said, there's not a whole lot of vendors selling this product and they're making a killing on their margin. What did Amazon go and do? Hello? A lot of the products that you buy are made by who? Hello, that is why they are literally one of the most successful companies on the planet. They created a marketplace and then they compete with everyone else. Some might call that a monopoly. Some might call that a little bit unfair. Imagine if you were all of a sudden working with all these brands and saw an underserved product that people were buying. Well, now we can deliver data to the brand saying, your next run should be 3 times bigger based on the data that we're getting. And they're going to say, yeah, but I don't have retailers. I need a marketplace. And what makes retail so unattractive is that you have to have a couple $100,000 of inventory. But now if you need 10% of that cost to actually start a business, how many of you think that might revitalize the retail space in a very dramatic way? It'll be crazy. It'll be huge. So when I look at Thatch is an opportunity to change the way that we do business. And what it does is it brings data, it brings acceleration, and and here's my favorite part, the largest companies are already doing it. They've proven it. It just hasn't trickled down to anyone else yet, and no one's tackled that challenge. So the idea is ripe, and if Dan doesn't do it, and if you don't help us do it, someone will. And right now the market is completely open, and the competition is zero. Very, very, very bizarre. So Dan's question now is, how many of you would be interested in maybe opening a retail store if you had insider information on really cool, high profitable brands? Don't be surprised if that comes around the corner.
Yeah,
in the
and
next
that's
year or
actually a
two.
big part of it is that information, right? I mean, there's another layer of this. I have a friend who owns an affiliate marketing agency, and they work with big brands to help them sell stuff online. And when I was telling him about this, he was like, hey, what if we used our affiliate linking? We know everything that people are clicking on from all these affiliates online that put out all this content. We know where they are when they click. And we just send them somewhere else to buy online. What if we could send them somewhere to buy locally? Well, what if we could stock ahead of that? We know what they're clicking on. So we know what people are in demand of. And we say, hey, brand, we need to get some product into this town over here. We need to get more product in here. And we then go to the retailer, or maybe you're an entrepreneur, you're going, I'm looking at the data, and I'm going, there's opportunity for me. If I open up the store, I know there's already demand for what I want to sell. We're feeding you that data.
Yep. So let's do this. Let's open it up. We've got some time for some questions. This afternoon and tomorrow, we are going to be presenting 2 new opportunities that you have not heard of or about. But I believe that Thatch, as a staple, is one of our most important investments that we're making, because we're going to look back in 5 or 7 years and we're going to say, how did the story end? And I'm personally running my own math to find out how close or off I'm going to be. And I think that Thatch has an opportunity for lion's share winnings. I think it has an opportunity to, when we talk about asymmetric, some things have 100x upside, and that's wild. I think this is way bigger than that. And we'll have to see, right? No promises, no guarantees, but we are trucking forward like it's the biggest thing. So questions? Let's go ahead.
Hey guys, I'm Russ again.
Hey, Russ.
I'm so excited about this. Like most tech things, it might as well be another language. Thank you. I can't understand it, but like this is so simple. Makes perfect sense to me. I get it. So thank you guys for doing this and letting us be a part of it. My question, what is the current valuation that we have the opportunity to buy in at?
So great. Let's back up one slide, and I want to explain this because this is a very important fundamental question. When you're purchasing a company, it either has a valuation or it's pre-valuation. You need revenue in most instances to create valuation. Many of you are aware of that. But if you're a little bit new on this one, because what you have right now is a theory, you have theoretical nearly complete technology, you have theoretical people who have said they will sign up and use it. Everything is theory. So right now, trying to evaluate an idea is really hard. In that case, what a lot of people do is what's called a safe note or a convertible note. And what that means is money goes in, and what you end up getting is a discount on the money that's invested. You earn a basic interest rate on your money, and the moment the company hits its first valuation period, you're given an opportunity to basically convert your convertible note, your safe agreement, then into stock in the company at a discount for basically being a first mover advantage. Here's the cool thing about it. If the company waits and delays its valuation too long, it's going to give you a lot of stock. And yet the company can't achieve an official valuation, third-party valuation, until it has some revenue. So what usually happens in situations like this is you've got generally 12 months to 24 months where the company is getting off the ground, generating revenue, and it has its first evaluation event. When that happens, it automatically triggers a conversion on this note. And at that point, that's how fair valuation will be achieved, minus the discount and the interest that's been accrued along the way. Does that make sense?
It makes perfect sense. Do you guys have an idea of what you think that valuation will be, or is it too early?
Well, if we go back a couple of slides and talk about the future, go back to right around here. Let's actually go back to the slide where we talked about 100 brands, 500 million, and let's talk about this. The multiplier that we had shown earlier on this was how much? It was.
Actually,
Let's find the multiplier. I want to show you. I want to show you guys this. This is
actually,
important.
it was not in the deck, but we have it as a bonus slide. So it's 47.7 times EBITDA.
Okay, so I want to show you how to do this math because this is really important. Let's say that the company.
Let's go back to the.
Yeah, let's say the company had $500 million in brands that it onboarded. Now, these are brands that are already selling to retailers. All they're going to do is say, hey, guys, we're going to do it a little different. We are not going to PO you and charge you anymore for inventory. We're going to carry it all. but you have to use our brand new Thatch system because the moment a sale is made, you keep money and we keep money, but the benefit is you don't have to keep inventory. That's a beautiful trade, and the brands are thrilled about it. So let's just say that we onboarded 100 brands, and that represented a $500 million of sales already occurring. This is like picking a different payment processing system, and 10% of that now flows to Thatch. Now, by the way, why would they be willing to give up 10% real quick? Are they stupid? No, it's called the velocity of money. Right now, their velocity is 2 to 3 times a year is what they get to reorder. Now they can reorder as whatever batch size makes the most sense economically. They can do frequent reorders because of the data coming back. Does that make sense? So if Thatch has $50 million revenue, the question is, what is its EBITDA? Simplified, what are its profits? What's its profit margin going to be? Dan, as you've evaluated profit margin and you guys understand the beauty of software and how it does a lot of the work, and we have AI integrated into this, the question is what the profit margin is going to be on $50 million. Do you have any guess whatsoever? Because we've had conversations about margin. And this is, by the way, don't hold us accountable to this. I want to give you an illustrative example.
It can easily be $40 million.
Okay, now that's 80%. Let's just say it's actually half though, not 80. Let's just say it's 50%. So of the 50 million, you have $25 million of revenue. What's 25 million? Someone pull out your calculator. I want you to do the math. 25 million. You're gonna have to hold your phone sideways or it won't calculate because it's a big number. If you take 25,000,000 and multiply it by 47.7, no, someone tell me the number.
Can you read it with the zeros?
Almost 1.2 billion.
1.2 billion.
1.19 billion. We'll just round down and call that a billion. Get 100 brands that are processing $500 million through your system, and you achieve a $1+ billion evaluation. How many of you understand? And by the way, Dan, these 100 companies came from how many trade shows?
2.
2. How many of you think that 100 billion sounds like a crazy, out of reach, unachievable number now? How many of you think that that's just working at it and putting some time in the business? Does it start to make sense a little bit? So when you onboard a brand that does, wow, we just got a big account, they're processing $20 million. And you say, that's $2 million of revenue to the company, and that's $1 million of profit times 47. You've just achieved a $47 million evaluation. That's the best answer that I can give you. And that's math that you want to know how to do.
So if I'm doing my math right and you guys hit the 100 billion, we're looking at like a little over a 200x. Is that right?
Love you, Russ. Yeah. Yeah. That's not a greed
I
smile.
like that.
That's a happy smile. That's like, by the way, when you have struggled in business and then you learn how to iterate and get smarter and better at it, it feels good to win. Feels good when all the economics line up. And for me, this is a really beautiful, complete story. This is one where I just happily fund it myself. But I love taking these. I have a philosophy. There's an opportunity I'm going to show you. I'm going to pit stop for a second. Can I tangent for a second? Yes. I got a partner that I'm going to introduce you to tomorrow. He's flying in town for a presentation for the final company in the evening that we're going to be presenting to you. And I'm just going to chalk it up as, and you'll review the numbers, but I'm just going to call it a $1 billion play. This gentleman said, Chris, you and I do so well. Why would I open this up to your investors club? Why would we take on shareholders? Do you know the level of oversight, responsibility? Like, he said, in my world, we just fund everything ourselves. Now, that sounds a whole lot like a person that I was hitting on earlier. Who was that? Rhymes with Glamsy. Rave Damsey. So, this individual said, Chris, why on earth would we, I don't need $500,000 or $1 million of this people's money. Why would I do that? And I said, well, and I'll leave his name out for a moment. I said, let me ask you, tell me what happened to your company 4 years ago. He says, well, we had too many companies, 26, and we felt stressed and overburdened, and we consolidated down to 12 companies. And he says, we're happier now. I said, let me guess. You were stressed and overburdened because you were splitting up resources, your human capital and your financial capital, to keep growing more things. And he says, that's exactly what happened. And so I said, well, it must feel good to own things paid off, but not to me. The goal isn't to be debt-free, ever. The goal is to control money. You want to control it. You don't want paid off stuff. I don't even care if I don't own assets. I want to control the flow of money. And I said, give up $1 million, exchange it for some equity in the company, and now all of a sudden we can hire dedicated CEOs instead of borrowing half of yours and half of mine. In fact, we don't need to borrow any human capital at all. We'll hire dedicated people. Now you won't fall behind on your other company's projects because you have the dedicated resources for this project. And now your original goals on your company will go faster, and this one can go as fast as it does. And in the game of velocity, he said, you're right. We will own less. But through speed and velocity, we will make more. Which is why ownership is overrated. Which is why paid off things is overrated. It is ultimately fear-based in the mind, and you aren't acquainted with what the real objective is. I said, what do you really want? He says, well, I want to have the biggest company that grows the fastest. I said, good. Stopping. Stop borrowing resources. Stop slowing all engines. Does this make sense? So I said, I'm going to let it be your call, but I basically made my persuasive argument. And at the end, you know what he said? Let's let the Investors Club have at it. And that's going to be a monster winner this year. I also believe this is going to be, in the short and mid and long term, a monster winner. And an opportunity, if there was ever a company that definitely had the right to go public, this is definitely one that falls into that category. And when that time comes, it's always smart to take chips off the table, but it's also important to not take everything off the table, because this is one that's going to reevaluate RV over and over and over again. That's what I see for its future, and that's the end of my tangent. Yeah. What were we talking about?
Questions.
Questions. You guys got 4 minutes of questions with this man. Let's come right over here.
Hi, my name is Richard.
Hey, Richard.
So is this going to be part of a fund, or will it be an individual direct with this specific investment?
So I don't believe in syndicating individual opportunities to you for 2 reasons. Here's the first problem. If I show you 10 companies, and let's say there's 2 that you really fall in love with, then you're putting your eggs in how many baskets? A lot or few? You're putting eggs in few baskets. I have a problem with trusting you that way. So I've set up a system that says I don't allow that, because that's how I see people predominantly get hurt, is they fall in love with things, and you shouldn't. You need to fall in love. If you're going to fall in love with one, this is different than marriage. I want you to fall in love with 10 women at the same time over the course of a year, okay? It's not how we play it. We're very monogamous in our relationship world, and I'm completely polygamous in business. Sorry, I erased it. Don't quote it. Don't put that on a shirt, Carson. I didn't mean it. Okay. The second quandary is it has to do with when I individually syndicate an opportunity, you're going to find that minimums are usually 50 to 100K. And what that does is that forces people to put in fewer opportunities. By pooling them into a fund like Thatch, what it means is there's a minimum of 5 things in there, which allows your strategy to include the diversification. So if you personally go up to Dan and say, hey, I love this, I'm in all these things, I want to just dump money into this thing, Dan, what are you going to say?
Invest in the Udacity Venture Fund.
Yeah, meaning it's the safest way. Now, on the other hand, if you came up to me and said, Chris, I'm a certified investor, and I have $100 million, and I would like to do X or Y and Z. First of all, that person isn't putting all their eggs in one basket. Second of all, I don't think we have that much capital need. And so I'm more of a share the love. You're not going to find a socialistic version of me very often, ever at all. But in this group, if I can let everyone get a benefit, you've all done a lot to qualify and made personal choices in your life to put yourself in this room, then we're going to make that opportunity available to everybody.
Appreciate you.
You're very welcome, Richard. Great question. Give it up for Richard. We're going to do one here, and that'll wrap us up for Q&A on Thatch. Come right over here.
Hi, everybody. I'm Matthew.
Hey, Matthew.
Hey, awesome job explaining Thatch to someone who has no idea what this space is, right? One of my questions would be, what is a reason that a brand would not want to partner with Thatch? I mean, it's not all sunshine and rainbows. Nothing ever is, right? And so what's a downside?
Yeah,
of
that's a great
adopting
question. My quick answer is they're so stuck in their old model, they have a hard time actually moving on to like, oh, there's a better way to do business. And that's usually where they get stuck. So meaning like, I'm winning at this game. Like the ones that are doing really well, they're like, I like the game that's being played. I'm winning at it. Why would you come in and mess that up? So they have a hard time getting out of their head. But when you break it down by the numbers and you go, look, we like, I get it. Maybe you're already got, saturation in as many retailers in the country as you want, right? But you don't have as many controls. You don't know the data. And you're missing out on sales that are walking into those stores because I guarantee those retailers are bad at restocking and ordering the right quantities, and they're the ones taking the risk, so they're probably under ordering in the first place. So it's a breaking it down by numbers. But that's usually the main resistance I get is they just have a hard time getting out of their old, getting out of their head of the old model of like, I win at this model.
Yeah, so you could have some large companies out there to say, we're actually really optimized, and we're at the point where we do great training with retailers, and we've got great communication back and forth. They might look at that and say, I don't know if we would benefit so much from the velocity and from the data, and that's gotta be like less than point-something% of the marketplace, because imagine for a moment if the success of your business relied on hundreds of other retailers who are running their company with all of their own systems, all of their own cultures, you think all of them are honoring you? You think they're organizing their life around you? They are they are connected to the market that they just can't control. Thatch says we can bring that control to the marketplace and force that vendor-managed inventory to actually take place.
Yeah, a little backstory on the name Thatch. If you think about what thatching is or a thatched roof, it's the bringing together of a lot of small things into something really strong and powerful. And so we're thatching brands and retailers together. And it's a network effect. And we have gotten some resistance from brands that can't get out of that old mindset, but eventually it will be the dominant way. And the retailers will just demand it. But they'll want it, and then they'll realize we should have been doing this in the first place. And even then, with most major brands, they can always try it. They don't have to go all in. They mean, okay, let's try it in a few retailers. Let's see what happens. They can risk a little and then go, oh yeah, the data's really good. Let's keep doing this.
My friends, really great questions. And the great news, Dan's a member here. And so as you have questions today and tomorrow, you can have those personal conversations with Dan. I'm really excited about who Dan is. I see us actually innovating on a lot of technologies and companies in the future. And do me a favor, if you guys are excited genuinely about this particular opportunity, let Dan hear it, because he's done a lot to bring it to the table. Awesome job, brother. Thank you. Awesome.